This is level 2 of the CFA program, the topic on corporate issuers and the reading on capital budgeting. Let me begin by providing you with a super dull definition of capital budgeting, one that you would read in lots and lots of textbooks. You might need to lay down and close your eyes for this one. Ready? Capital budgeting is the process of planning for the investment in long-term assets. Let me follow that up by a much more exciting definition. Let's call this Jim's idea on capital budgeting. And to do so, let me just tell you a quick story. Let's go back to around the year 1900, and there were a handful of young men who loved fishing, and they grew up in Wisconsin, and they had to bicycle up big hills and down hills and up hills to get to their favorite fishing spot. So they thought to themselves, I wonder if I put a motor on this bicycle, it will help me. Of course, I'm talking about Arthur Davidson and William Harley, the founders, with two of Davidson's brothers, by the way, of the Harley-Davidson motorcycle. The original design was just to get them to their fishing hole in a much more efficient manner. And then sooner or later, other people saw them riding bikes and they said, hey, make one of those for me. So what started out was kind of a personal idea to improve the quality of life expanded to this huge conglomerate after over a century in which Harley-Davidson motorcycles are sold throughout the world. And you'll see that as we go through these learning outcome statements. All right, calculate yearly cash flows, depreciation, inflation, optimal capital budget, sensitivity analysis, real options. That's going to be a super fun handful of slide decks. Pitfalls, and then some other ways that we're going to kind of look at the budgeting process here. It'd be fascinating if we could get in our time machine and go back to the year 1900 and ask Arthur Davidson, hey, how did you handle your capital budgeting decision when you started manufacturing motorcycles? How did you do equivalent annual annuity approach? What discount rate did you use? Counting income? And he probably would look at me if I were the time traveler and say, dude, we were just interested in going faster and getting to our fishing holes. And then we realized that there were lots of other people who were probably interested in the same thing. Now, what I want to do is I want to point you to that LOS down there near the bottom. Describe types of real options. I want you to think about this. This Harley-Davidson has the classic real option. Of course, they were unaware of it at the time. And lots of people, even today, are unaware of the real options inside of capital budgeting projects. But what happened was that people started buying these motorcycles to go fast, and they realized that they were super fast, and so they started entering them in motorcycle races. And Harley-Davidson motorcycles started winning all of these races, and this is how the brand name evolved. I mean, imagine a commercial in 1900 that says something like, hey, buy our motorcycle, go fishing over there, or buy our motorcycle and win a race. That was the beginning of the branding of Harley-Davidson. Now, I'm pretty sure that William Harley was the chief engineer, but he was also the treasurer. And I'm guessing that if we could go back through time and we explain these kinds of things to him, he would say, oh yeah, we're aware of all this stuff, but we just didn't do the math. We didn't do the technical analysis. We didn't have Excel to be able to do sensitivity or scenario analysis. We clearly didn't have computers to do a Monte Carlo simulation. All right, let's start with that first one. Calculate yearly cash flows. I mean, this is a super important part of the capital budgeting process, right? What did I say to you in that dull definition? Planning for the investment in long-term assets. So what we need to do is we need to worry about how much does it cost us today, and then what are we going to get out of it in the future? Well, what we're going to get out of it in the future is these calculate the yearly cash flows, not calculate yearly net income. Remember in just a recent recording back in those accounting readings that we had, I mentioned not so briefly that net income and cash flow are different, and they're super different, and that's important here. We're worried about cash. All right, so two examples here that we'll cover, an expansion project and a replacement project. All right, so an expansion project, let's start with that one first. Investing in new assets to increase the size and earnings of a business. All right, that's kind of a big picture goal. What's the goal of the business? We know is to maximize shareholder wealth. So we want to make capital budgeting decisions that are going to do so. And of course, the end result is when we invest in new assets, we're going to expand the left-hand side of our balance sheet, which then automatically means we're going to increase the size of the right-hand side of the balance sheet. And then hopefully, notice we have earnings in bold over there. Hopefully that's going to show up over on the income statement in an increase in earnings as well. If our projects are independent, they will not affect the cash flows of the rest of the company. Now that's important. In a few slides, we're going to talk about mutually exclusive projects, and that's going to be a little bit of a different example. All right, so what do we do here? Initial investment outlay. This is kind of like the marginal cost, and we're pretty certain with our estimate of this initial investment outlay. So investment in new fixed capital equipment, right? So we've got to do, some kind of an asset. Maybe we'll have land, machinery, equipment, all that kind of good stuff. Plus, we're going to have an investment in net working capital, and that's going to sum to our total initial outlay. Now, let me move from motorcycles to donuts here in just a second, because I promise you that this might help you on the exam, and it might help you understand about this net working capital. Let's suppose I'm Jim and I have Jim's Bakery. And what I want to do is I want to redesign one of my machines to make broccoli donuts. Feel free to be disgusted by that example, but I promise you it's gonna resonate and you're gonna remember this. So what do you have? Before this investment, you have a bunch of cash laying around. Let's suppose it's $10,000. But now you're making a broccoli-filled donut. You have to have an investment in broccoli. So that's going to be a short-term investment. So you take the $10,000 in cash and you buy broccoli. So think about me. I'm Jim, my bakery. I have a big pile of broccoli in the corner, $10,000 worth of broccoli. That's going to represent my initial investment. So look at the orange circle there. Investment in net working capital. So working capital, right? Current assets minus current liabilities. All of those accounts on each side of the top portion of the balance sheet, and then we'll net them. So, we have accounts receivable and accounts payable and all that stuff. But I think if you think of inventory and broccoli sitting over in the corner, it's short term, of course, right? Because if you don't use the broccoli today, what happens to it? Well, the rats will come by and eat it, and it will deteriorate. And the ants will get it, and it'll get rotten. All right, so short term, that's important. So we take the long-term investment in the purple and the short-term investment in the orange. That gives us our total initial outlay. So think of that in your microeconomics days as the marginal cost in this capital budgeting process. So then you have to ask yourself, all right, if I'm giving up a bunch of stuff today, what do I get out of it? And the answer is, well, you get these after-tax operating cash flows, and you get them next year and the year after that, and in 5 years and in 10 years. You get a series of after-tax operating cash flows. Think of those as the marginal benefits. Now, here's a really cool thing that I emphasize to my students. That initial cost can be estimated with relative certainty. These after-tax operating cash flows, remember, we're making a prediction in year 1 and 2 and 3, so we're trying to predict the future. This is uncertainty. This is risk. So I always emphasize to my students that these are risky after-tax operating cash flows. All right, so I'm sure you guys remember this little formula back from level 1. So let's go ahead and quickly go through this on the right-hand side of the column. So we're going to start with sales. We'll subtract out our cash operating expenses. We'll subtract out depreciation expense, and that gives us, some measure of operating income. We could call that EBIT, right? Then we'll take out the taxes, and then we'll add back depreciation, because remember, up there, when we subtract out depreciation, it is a non-cash expense used solely to lower the tax liability. So in order to get the true sense of cash, we need to add it back. And that gives us our after-tax operating cash flow down on the bottom right. Now, take a deep breath, and what you should be saying to yourself is you should be saying, okay, Jim, I can see that this is not net income. for a number of reasons, but one of the big reasons is that nowhere in there is there anything called an interest expense. So in cash flows, we're going to ignore the interest expense. I'm going to repeat that. Ignore the interest expense when computing operating cash flow, not because we're knuckleheads and we're just forgetting about it, but because if we subtracted it here, and then when we take the present value of these operating cash flows, we're going to use interest expense to compute our yield to maturity on the bond to estimate the weighted average cost of capital. And we're going to use that to compute net present value. So if we count it here and we count it there, we're going to be counting it one too many times. All right, so what do we have in the purple? We have after-tax salvage value plus a return on net working capital. That's going to give us our non-operating cash flow. All right, so you ready? What we're going to do is we're going to generate these after-tax operating cash flows for a fixed period, let's say 3 years or 5 years. And then at the end of the life of the project, we're going to terminate the project. We're going to sell the asset. We're going to get back the return on net working capital. Think about this. After we stop making broccoli donuts, we don't have to have that big $10,000 pile of donuts over in the corner. All right, so this LOS, calculate yearly cash flows. So we did that, and then we're going to add the terminal year after tax non-operating cash flow. So let's go ahead and work through an example. And this could be Jim's Bakery here, right? I want to buy some land, non-depreciable land, $37,500. I need to buy some land in the field behind my factory. I need to put in a whole bunch of equipment so that I can make these broccoli donuts, $262,500. So there's my initial investment outlay of $300,000, net working capital of $40,000. So, gosh, boy, you thought that my pile of $10,000 worth of broccoli was big. How about a $40,000 pile of broccoli? All right, so what are we hoping to do? We're hoping to sell these donuts for pennies. There we have 100,000, right? I'm sorry. Make these donuts for pennies. There's 100,000. Sell them for dollars. There's the 320,000. Tax rate of 40%. Project life 5 years. Required rate of return 10%. We'll depreciate straight line to 0, and we're going to sell the asset for $75,000. That last arrow point down there is a huge assumption. Imagine trying to predict what you can sell a broccoli machine in 5 years for. I mean, think about it. You're either going to sell it for $0. Actually, you probably have to pay somebody to come and take it off your property. If this is a total disaster, which we probably all agree that it might be, but let's suppose for some crazy reason that people love Jim's broccoli donuts, then I could sell it maybe for $75. Oh boy, if I'm a super good entrepreneur, maybe I could sell it for $75 million. All right, so there's our initial outlay. So long-term 300, short-term 40. That gives us the 340 after tax operating cash flows. So there's the 320 in sales, the 100 in cash operating expenses. Right there's depreciation. So 52,500. So let's make sure that we get this one right. So there's the equipment, 262,500. Divide that by 5 years, right? So that'll give you 52,500. And then we need to remember that, of course, we're not the only people involved here. The government is interested in how much money we're making. So 1 minus the tax rate, that gives us our after-tax operating cash flows. Add back the depreciation. So there's 153 as our annual after-tax operating cash flow. Then, of course, we need to figure out what's going to happen at the end of year 5. We're going to sell it for 75. We're going to get back the 40,000 in broccoli because we don't have to have that investment anymore. And then once again, the government is interested in us paying tax on our capital gain. So that gives us 100,000. And so, boy, there's the math if you want to do it the super duper long way. But here, let's treat this just like a bond. You ready? Get out your calculators here. I got my 12C. So let's do this. You guys remember I can't see. So you ready? So do 153,000, make that payment. And then do the 100,000 because that's the terminal, make that future value. And then 5 is N, 10 is I, solve for present value. So this is just the present value, 642. You guys have that in your register, 642,082. That's the present value of the marginal benefits, right? So our marginal benefits accrue in the future. They're risky because, now look, I'm pointing at the screen, but I want you guys to look. We're trying to estimate revenues and expenses and tax rates. Geez, who's good at predicting tax rates with, the politicians telling us we need higher corporate tax rates, we need lower corporate, who knows what tax rates are going to be over the next 5 years. So these are risky operating cash flows. Nevertheless, they're the marginal benefit. So we expect to get 642. So then just do 340 as our initial cost, add that, and you get the 302,083. That's the simplest way to do this kind of a problem. And this is the similar problem to what is shown in the reading. So I would probably know that shortcut. Although here in the next slide, we put together the BA2 plus. The advantage of having the BA2 plus is that, when you hit that cash flow button, you can hit your toggle up and down and you can see your cash flows as you entered them. Me, I hit this thing here. Who knows what I hit? Because a lot of times I transpose numbers in there and transport numbers. So I have no idea what I entered on this thing, but with the BA2 plus, you can go back and confirm that you entered those in the correct manner. So there's the NPV 302. So what do we say? Here we got 302. Here we got 302. So the net present value method says, hey, invest in any project that has a positive net present value, therefore accept. And the reason is because, you ready for this? The present value of the marginal benefits exceed the present value of the marginal cost, right? Present value, that means today's dollars. So we are $302,000 better off by making this investment, right? That's present value. Look, let me shout at you. It's net present value. Measures the change in shareholder wealth. So of course we want positive net present value projects. In fact, almost every decision that you make during the course of your lifetime can be considered in the capital budgeting framework. Let me give you a personal example. Look, 30 some years ago, I stood someplace with a bunch of my friends and there was a person right there and I said, I do. And when my wife and I got married, I said, yes, this is going to be a positive net present value project. I'm giving up some things, right? But I'm getting a lot of stuff. And of course, in the 30 years of our marriage, how about if I just tell my wife our net present value is $302,000? She would just shake her head at me like she does all the time. Boy, how about the second part of this one? Evaluate how the choice of depreciation method affects those cash flows. All right, forget about the slide for just a second. Think about depreciation. What did I just say to you a few moments ago? Depreciation is the non-cash expense. It is the initial cost divided by the expected useful life of the asset. And so what you're saying to yourself is, okay, I have these non-cash expenses over, let's say, 5 years. And so what the government is allowing me to do is to take that non-cash expense and lower my tax liability for each of those years as compensation for taking that huge capital initial investment, right? So as a tax subsidy, an incentive to invest, the government gives us a tax break. Now, of course, the government is not doing this because they say, hey, we think you guys ought to pay lower taxes. The government is saying, look, when Jim, you have your bakery, right? When you make those broccoli donuts out there in your new piece of land, you're going to hire 100 workers out there. And so if we give you a tax break of, let's say, $100 a year, all of your workers are going to end up paying income tax for $200 a year or $600 or $800. So the government makes out on this. Now, what does this have to do with capital budgeting? Of course, this leads right into the process that if we have depreciation methods that allow us to accelerate the depreciation. In other words, what did we do in that last problem? We had, I forget that number, 52,000 something, 52,500. That was straight line depreciation. But suppose that we depreciated it 90,000 in the first year, and then 60,000 in the second year, and then 30,000 in the third year, et cetera, et cetera. Well, what would happen? Look at that third orange, purple circle point. Higher depreciation leads to, forget about the lower income there for just a second, higher cash flows because we have a higher reduction in tax liability. Now, it will also lead to lower net income. Of course, it will. The difference between net income and cash flow is a bunch of things, but a primary difference is the treatment of depreciation. So look at the last red arrow point. This is what I was saying just a second ago. Accelerated depreciation method increases the net present value of a project relative to straight line depreciation methods. Let's go ahead and take a look at this really scary table. I remember I was in graduate school in 1986 when the politicians decided on that 1986. Gosh, were any of you even born in 1986? So we came up with this modified accelerated cost recovery system. You should remember double declining balance, some of the year's digits. Boy, I really hated those calculations back in my accounting days. This kind of gave you the percentages here, and it lumps every asset, regardless of what it looks like, into different kinds of classes based on years. Here's just a quick example to address that LOS, evaluate choice of depreciation, right? So here's a quick example. Asset cost $50 million, depreciated as a 3-year asset. So $50 million. So there are depreciation percentages that we get from our table back here. And of course, the Institute would give you those percentages. They would not make you memorize them. Although I always scare my students whenever I do stuff like this. I'd say, hey, you need to memorize this for the exam. And then I move on. And then after like 3 or 4 minutes, they'll say, oh, Jim, you can't be serious. So depreciation rates, multiply each of those by 50 million, and you get the amounts over there, 16, 22. And then, of course, if you sum them, they have to sum to the initial cost of 50 million. So what is the present value of the tax savings? So as you can imagine on the next slide, on that right-hand column over there, all we're going to do is take the present value, and that's what we did right there. And so if you want to pause and verify the math, you get the 1498 down on the bottom right, present value of the tax savings, $14.98. And of course, the way we did this here on this slide is we just divided by 1 plus the interest rate, which was given as 10%. But of course, you could use your cash flow buttons, cash flow 1, 583, cash flow 2, 778. You could do that and then just hit net present value. All right, all that for the first and third parts of that LOS. How about a replacement project? All right, suppose we replace older equipment with new or better equipment. So we need to identify those relevant cash flows, right? So the initial outlay is going to look an awful lot like it did just earlier for the expansion project. So we have the long-term investment, right, and the short-term investment. The reading calls this, fixed and net working capital. And then we need to worry about, okay, what are we doing with the old equipment? Well, we're probably going to sell it. And when we sell it, we're probably going to have some tax obligations. So that's the minus salvage value and then the tax implications there on top of the capital gain. Second part of this, what did we just do? Calculate yearly operating cash flows. We did that for the expansion project. Now, for this replacement project, we need to make certain that we consider the incremental operating cash flow, the difference between what the old machine was generating versus what the new machine is expected to generate. So notice that we have the little triangle sign there. That stands for delta or the change. So we're doing the change, and this equation is exactly like it was before, but we're taking differences there to get the incremental operating cash flow. And then, of course, there's the terminal year non-operating cash flow, which looks pretty much the same as it did before. So let's take a look at a super quick example here. So old equipment down the left-hand column, new equipment down the right-hand column. We give you a whole bunch of stuff there. Things like sales and expenses, things like depreciation, and then, of course, book values and current market values and initial costs. All right, so let's go ahead and quickly compute this initial outlay. And notice in parentheses there in blue, we've put the weighted average cost of capital in this example is 8%. The reading calls this the required return on the equity capital. 3 R's. All right, so there's our $900,000 fixed in the equipment. There's our $72,000 in our broccoli. What are we doing? We're going to take out the current market value of the old equipment. So look at the 500,000 there. So we're going to sell it for 500, and then we need to pay taxes on the difference between what its accumulated depreciation and the current book value. So there's the 500 minus the 300. So that gives us an initial outlay of 532. Second step then is to estimate the incremental operating cash flows. And so notice the new equipment sales 500, old equipment sales 350. So here's the first part. This new equipment is going to be able to generate a product line that allows us to increase sales. Now, we'll probably have an increase in operating cash flows too. In operating expenses. So there's the 170 minus the 150. And then since the old equipment is probably old and the new equipment is probably new, we'll probably have higher depreciation. So there's the 95 minus the 35. Multiply that by 1 minus the tax rate, and then add the change in depreciation there. So you get those operating cash flows incrementally 109,000. And then the final cash flow, we're going to take the 220 minus the 110. So there's the difference in salvage values. We're getting back the 72. There's our broccoli investment. And then we've got to pay a capital gains tax on there. So 149. So let's go ahead and do the net present value. So you could use this using the cash flows, or you could treat it like a bond like I just did earlier. So you get 268,415. So we say, therefore, accept, because net present value turns out to be positive. Notice we did a quick IRR calculation. And remember, the advantage, of course, of using your cash flow buttons here is that all you have to do, you do the gold NPV, then you can just hit the gold IRR. It's right there for you. So make sure you read the question on the exam. If it says something like compute NPV and IRR, make sure you use the cash flow buttons so that you can go ahead and get that IRR calculation pretty quickly. What did I say earlier? In that blue box, the weighted average cost of capital was 8. So the IRR is 17, greater than 8. Therefore, we accept this project. Boy, that was a lot for one LOS, wasn't it? But it was worth it. All right, how about inflation? So what do we know about inflation? We know inflation simply means that if we go and buy a loaf of bread today for $1 and we go and buy a loaf of bread tomorrow for $1.10, that the rate of inflation over one day, that's 10%, right? The percentage change in the price of our consumer goods or any kind of good that's or service that's out there. A couple of things to think about here before I get to this slide. First of all, remember that inflation for bread doesn't mean inflation for oil or inflation inside of the capital budgeting process. And so what financial analysts and financial managers need to be keenly aware of is that there's probably a rate of inflation for revenues and probably a rate of inflation for expenses. That's why we have the CPI and the PPI, of course, to reflect those differences there. But so let's take a step back and say, all right, how do we count for inflation? We can do this probably one of two ways. When we estimate our future cash flows, we can just incorporate inflation in there. I do this to my students all the time. I say, hey, here's current sales. They're going to increase by 2%. And here's current expenses. They're going to increase by 2.2% or 1.8%. So when we use inflation to compute the cash flows, we call those nominal cash flows. So therefore, we use the nominal discount rate to discount those nominal cash flows. And that's probably the most reasonable, the most commonly used. But what we can do is we can estimate real cash flows. And there are some good reasons to estimate real cash flows. That's probably not a part of this learning outcome. But here, you ready? Real cash flows are adjusted downward. So we're going to use the real discount rate to discount those real cash flows. So my advice is to make sure when you read the vignette, to think and search for those words, nominal cash flows or real cash flows. and then adjust it accordingly. And of course, there's an equation at the bottom that you probably remember from level 1. Where would this have been in? This would have shown up probably in the macroeconomics reading, right? 1 plus the nominal rate is equal to 1 plus the real rate times 1 plus the inflation rate. And of course, at the risk of offending you, let me just remind you that the 1 plus there, that must reflect compounding. Now, here's a good slide to remember for one of those questions that show up at the bottom of a vignette where you have this whole capital budgeting thing, and then at the bottom there'll be a couple of comments about inflation, and then somebody in the reading, let's say it's Betty says something like, oh, here's inflation, how are we going to handle inflation? And the question 6 or the question 4 is going to be something like, do you agree or disagree with Betty? And tell me why, et cetera, et cetera. All right, so let's go ahead and go through these boxes on the left. So inflation can affect a project's profitability. Of course, lower than expected inflation is going to lead to future cash flows that are worth more. So lower inflation will probably increase the value, the present value of the project. However, we need to consider what happens with depreciation. Higher than expected inflation is probably going to make the depreciation tax shelter less valuable, which is probably similar to what happens over the bond. Higher than expected inflation shifts the wealth away from the bondholders to the issuing corporation. And then look at that last one there, affects revenues and costs differently. This is what I was saying earlier. All right, remember what I said 15 or 20 minutes ago about independent projects, right? You can look at those independent because they're, after all, independent, so they're not going to impact other stuff. But when we have mutual exclusivity, then we need to worry about how this affects and impacts all of the other things that we're doing on the left-hand side of the balance sheet. Now, in particular, this LOS asks us to compare mutually exclusive projects with unequal lives. Now, here's my definition of mutual exclusivity. You ready for this? Let's suppose I'm Jim and I have a golf course. And my golf course is brown and my trees are dying and I don't have any flowers or bushes. And nobody wants to play my course because I'm built on the side of a hill and I never get any rain. So I'm going to pick up the phone and call Johnny the plumber and have him come out and give me an estimate to put in an irrigation system. And those of you who are homeowners, you know that you just don't have one plumber to come out to your house. You call multiple plumbers. So I'm going to also pick up the phone and call Jenny the plumber and have Jenny come out and ask her to do the same thing. And so let's suppose that both of these plumbers come back and I estimate cash flows and the net present value for both of them is positive. I'm not going to hire both of them. I only need one. This is mutual exclusivity. The acceptance of one automatically means the rejection of the other. Now, having said that, if Johnny and Jenny both estimate projects that are going to last for, let's say, 10 years, then we don't have this particular problem. We can just compute net present value and select the plumber with the higher net present value. End of story. But what happens if Jenny says, hey, my pipes are going to last for 8 years, and Johnny says my pipes are going to last for 6 years? What do you do with unequal lives? Now we have to scratch our heads. We could just compute net present value, but we need to be aware that, of course, at the end of each life, we're going to have to replace that sprinkler system. So we're going to do this 2 ways: least common multiple lives approach or the equivalent annual annuity approach. This will lead us to the maximizing wealth decision. All right, so let's consider 2 projects with unequal lives. And let's suppose project A is Johnny and project B is Jenny. And boy, don't really worry about the reality of pipes only lasting for 2 years or 3 years. Maybe this is 20 years or 30 years. Doesn't really matter. However, on an exam, you're probably not going to get one project with 19 years and one project with 17 years because who knows what the common live between 19 and 17 is. You have to get out your calculator and then you just think, okay, I'm just going to guess on this answer. All right, so project A costs 300. Net present value 76. There's the required rate of return 10%. Let's say project B 6860. So if we use just a regular old time net present value method, we're going to look at. Did I say Johnny? Johnny was project A, right? We're going to say, okay, Johnny, you come out, and we're hiring you to fix our golf course, right? Now, the implication here is that we're going to have to find the common life. And so if we have a 3-year project, we can duplicate that 3-year project at the end of 3 years to turn it into a 6-year project. If we have a 2-year project, we can duplicate that project at the end of year 2 and at the end of year 4 to have a 6-year project. So note, this slide is a really cool one because it tells you 6 years and 6 years. So now we're comparing projects that have equal lives. We're just going to replace each one. For Johnny the plumber, we have to replace it once. For Jenny the plumber, we have to replace it twice. So the question then becomes, before I move on to the next slide, the question becomes, would you rather have, as the owner of this golf course, would you rather have 2 76s or 3 68s? Now, of course, present value, we need to worry about that. Would you rather have 2 76s or 3 68s? Now, keeping in mind, here, let me go back here. We just said regular old NPV told us to pick Johnny the plumber, right? 76 is greater than 68, even though both of them are positive. So Jenny and Johnny are both perfectly acceptable projects. But the goal of the business is not just to increase shareholder wealth, it's to maximize shareholder wealth. So we're going to pick Johnny. So the question is, let me repeat, do you want to have 2 76s or 3 68s? All right, so let's do this. If we invest in Johnny the plumber, that's equivalent of receiving 76 today and 76 at the end of year 3. If we invest in Project B, which is Jenny the plumber, that's equivalent to getting 68 today, 68 in 2 years, and 68 in year 4. So just look at the timeline there. All we're going to do is take the present value. That's what I do at the bottom there, and we get 133 versus 172. Oh my gosh. So what are we saying? If we hire Johnny the plumber, we're going to make a mistake because Jenny the plumber over the 6-year period gives us an extra, what is that, about $40 worth of present value. Holy cow, that's a huge difference. All right, so we address that, evaluate capital budgeting projects using the common multiple lives approach. All right, so let's do equivalent annual annuity here second. And this one is super easy. Let's just go ahead and start with the net present value of each project. So if you get out your calculator, just put 76 in for present value, n equals 3, I equals 10. Don't forget, future value equals 0. Remember, your calculator is way smarter than you or I are. It will remember what that last future value is. That's why I always, before I do any problem in class, I mean, I'm in the tremendous habit, I just do a clear all, just do the clear finance, do the clear everything. If you have the BA2 plus, do the, second, there's a clear work, there's a second clear all, there's a second clear everything out of your memory brain, Jim. That's what I want to do. And then solve for payment, right, for each one. And look, there's Jenny the plumber over there. The equivalent annual annuity approach leads us to select Project B as well, which was, let me just go back here, super different than what we had originally started with. And this is probably the example that the Institute is going to give you. They're going to say, all right, compute NPV 76, 68. And you're going to say, oh yeah, let's pick Johnny the plumber. And then the next questions, you're going to say, wait a minute, what about all this extra considerations? Now, the good follow-up question, notice that the common life approach and the equivalent annual annuity approach, they lead to the same decision. There are probably some unique cases where this doesn't hold, but by and large it does. One of those cases is when the interest rates are different. Suppose for some reason Johnny the plumber and Jenny the plumber have different risk levels, maybe Johnny uses a plastic pipe and maybe Jenny uses a metal pipe. So maybe Jenny using the metal pipe, there could be some toxic degradation that comes up and that, I don't know, does something to our golfers on the golf course. So if we have different interest rates, then these two things may not agree with each other, but that doesn't have anything to do with, at least I don't think that has anything to do with these problems inside of the reading. All right, how about capital rationing? This is super easy. This is just exactly like I tell my sons when they go out and they say, "Hey, Dad, we might stop to get a slushie on the way home," and I say, "Okay, you have a maximum of $4 to spend on that slushie." And of course, we live in a world of scarcity, and corporations don't just have unlimited funds to invest in thousands or tens of thousands of capital budgeting projects. And so we have a capital budget limit, of course. So when we have this limit, we need to figure out which of the projects are going to be the best or the better combination of projects. And so here's a real simple example. We have $1,200, there's A, B, and C, 200, 800, and 200. So just on first glance, you might say, oh, well, we have enough money to invest in all three of these. But then on further review, notice the NPV of project C is negative, so you wipe that one out. Notice the profitability index is less than 1, so you wipe that out. So what are we going to do? We're not spending 1,200. We're only going to spend 1,000 and invest in those two positive net present value projects. Now, of course, if all three of these, or you had a fourth one and a fifth one, were positive net present values, then you'd have to allocate them according to either their NPV or their profitability index, and you probably arrive at the same answer. And there is a summary of what I just said. Notice, look at the fourth diamond point. The IRR is not as reliable. Yes, of course. A lot of reasons that we don't like the internal rate of return method. I give my students a problem where the cash flows change the sign, so you have like a minus 100 today, and then 60 in year 1 and 40 in year 2, and then a minus 20 in year 3, and then let's say 40 in year 4. If you put those numbers in your calculator can't get an answer. There is no internal rate of return for a problem like that. And so then I have my students, I say, well, hey, what are you going to do? And they'll say, well, let's go ahead and calculate NPV. And I say, exactly. Calculating NPV always gives you the right answer. All right, how about types of capital rationing, hard or soft? Fixed capital budget that can't change, that's a hard capital rationing. And soft is, of course, the capital budgeting is fixed, but it's not in concrete. And so there's always the option to overspend. Oh my goodness gracious, we'll talk about that in just a little bit. But I would make sure you know the definitions between hard and soft capital. That sounds an awful lot like a comment that could be made inside of a vignette. Hey, somebody thinks about rationing, difference between hard or soft. Do you agree or disagree with it? How about some standalone risk measures? And as you read the colors, sensitivity, scenario, and simulation analysis, you say to yourself, all right, Jim, I paid attention back under quantitative methods, and you taught us all about these things, of course. So let's just quickly review. Sensitivity analysis. So think of an Excel spreadsheet where you have revenues and expenses and depreciation. You have all that stuff for cash flows down the left-hand column. And then you have year 1, 2, 3, 4, 5, all the way out to year 10 million, right? And so what you're going to do, well, at the bottom, you have your little formula for net present value. So what you're going to do is you're going to change one input at a time and recompute net present value, and then change another one and recompute net present value. And it might be that when you change revenues from 100 to 105, that might have a minimal impact on NPV. When you change expenses from 81 to 79, that might have a minimal impact. But if you change the beta of the project from 1.2 to 1.25, that might have a dramatic impact. So this is what I love about this. Used to identify the most influential variable for success or failure of a project. So you're the executive who makes this decision. Yes, we're investing in this product line. You use sensitivity analysis so you can focus your resources on those that are going to have the most dramatic impact down in your bottom NPV calculation. All right, scenario analysis. This is where we estimate future probabilities, right? So most likely outcome, let's suppose that 75% is a regular old normal economy where we have normal demand for our product line. We have normal expenses. We don't have things like natural disasters. We don't have things like labor strikes. We don't have things like COVID, right? So the most likely 75%. But then we have a scenario like, hey, what happens if everything goes our way? What if I'm Jim's Bakery and everybody loves my broccoli donuts? Then we have this optimistic, right? The greatest possible outcome. Maybe that's 5% or 10%. But then we have pessimistic. Everybody hates Jim's donuts, right? So that's, what did I say, 8 or 10%? So whatever that other percentage is to get you up to 100%. So what you're doing is you're computing net present value on worst case scenario, best case scenario, and most likely scenario. Of course, the key input here is figure out what the probabilities are of those different kinds of scenarios. And then, of course, you can combine sensitivity and scenario analysis into a simulation analysis where you just hit a button on your computer and you say to the algorithm here, you go at it. It's anarchy inside of the computer. You go and change all the variables and give me 100,000 outputs, which will range from the absolute worst to the absolute best case scenario. And oh my goodness gracious, maybe it'll be a bell-shaped curve and a normal distribution, and I'll be able to compute, oh my gosh, dare I say it, value at risk and standard deviations. Oh, that's so much fun. Oh my gosh, am I going to go ahead and tell you that this is my favorite slide of the whole slide deck? Calculate. All right, so what did we say earlier? Required rate of return. What was it, 8% and 10%? I mentioned nothing at all about where that comes from. But of course, think about this. Let's suppose that my broccoli machine, I forget how much it cost earlier in that example. Let's just suppose it costs $1 million. Well, the question is, where am I going to get that $1 million? And the answer is, boy, it would be great if I had $1 million in cash laying around. But even if I had $1 million in cash laying around, I'm probably not going to want to use it because of maybe opportunity costs or maybe some other kind of costs out there. But I'm going to go to the capital markets, right? I'm going to issue bonds. I'm going to issue shares of stock. All right, so this market risk method here, this capital asset pricing model, that formula, which, by the way, you should have memorized back in level 1. And you should have memorized this for today. And you should have this memorized for the rest of your lives. Capital asset pricing model, of course, was developed in 1964 by, among others, this dude, William Sharpe, who won the Nobel Prize in economics back in 1990. And William Sharpe said something like, and I'm just going to briefly mention this because I say this to you in previous recordings. William Sharpe said, all right, what's a reasonable required return on Jim's Bakery? Let's start with the risk-free rate. Of course, let's start with the risk-free rate of interest because, well, Jim has risk. That's why there's a plus sign there. So we start with the base number, the base interest rate in the economy, and we add, well, what do we add? We add all the stuff that's going on the floor of the New York Stock Exchange. There's that expected return on the market portfolio. So suppose we own 1 share of every stock that's out there. What do we expect to get out of it? And then, of course, we need to consider the risk premium. So we take out the risk-free rate there. And notice we have those brackets there, and we weight it by the level of systematic risk. That's the beta. My relevant risk is systematic risk, beta, the sensitivity of my stock returns due to changes in economic information. Oh, my goodness gracious. How cool is that? So what we're going to do here is really simple. I mean, you have this institute has to give you those numbers on the right-hand side of the equal sign, right? So all you need to do is plug them in, get the required return, and then use it to compute net present value. Now there's a beautiful picture of the security market line there. Are you ready for this? So look on the horizontal axis, that's beta, right? And then on the vertical axis, expected return. And remember that beta is a standardized random variable, so it has a narrow range. Now, of course, most people would have you believe that the range for beta is between 0 and 2, and that's probably an okay way to remember it, but I can assure you that there are some betas during time periods that are negative and some betas that exceed 2. But when I wrote my dissertation, I calculated the beta for, I don't remember, maybe 2,000 or so different companies. And I had a handful of betas that were like a minus 0.2, minus 0.3, and a handful of betas that were 2.2 and 3.1. I think I had one that was around 4, but it's still, it's squeezed in. That's what a standardized random variable does. So notice on the vertical axis, we start with the risk-free rate of interest, and then we just move up the slope. That's the security market line. And of course, the slope has everything to do with the market risk premium. And then what we're going to do is we're going to use that required return here, just back here from this formula here, couple that with the yield to maturity on the bond. So look at the fourth circle point. The weighted average cost of capital is derived from this capital asset pricing model and the yield to maturity on the bonds. Now, of course, what we can do is throw the internal rate of return method in there and say we're going to accept projects that have internal rates of return that exceed this required rate of return. Of course, that makes sense. So let's just do a quick example here. 3-year project, beta of 1.2, 1,500, cash flows of 8, and there's risk-free rate and expected return on the market portfolio. So let's do NPV. So let's first compute the required return. So, and by the way, at the risk of offending you, when you put this in your calculator, don't violate the distributive property of mathematics. So start with a 9 minus 4. So do 9 minus 4 equals 5 times the 1.2. What does that give you? 6. Then swing back over to the left and get the 4. So there's 10%. And then there's the net present value using the regular old formula that you used back in kindergarten. Of course, you can do cash flow 0 is a minus 1,500. Cash flow 1 is 800, and then frequency, or n equals 3, I equals 10, solve for NPV, 489. We say therefore accept because the net present value is positive. But wait a minute, are you ready for this? Now we have super confidence in our decision because now we know that 489 was computed with our really super smart estimate of those future cash flows, right? $800 per year. But we're using a discount rate of 10%. Are you ready for this? That reflects the systematic risk of this particular project. So our accept reject decision depends on risk. Oh my gosh, how cool is that? How about real options? Boy, what did I say earlier about the Harley-Davidson example? So Arthur Davidson, all he wanted to do was get to his fishing hole fast. But what happened? What happened? He thought he could sell these motorbikes, or whatever they called them back in 1903, to his fisher friends, right? Whoever these other people were who wanted to go along fishing. But then these fisher friends, and of course the Davidson brothers, they started racing these and they started winning. How could they possibly have known that the brand name would have been a result of this real option? So the investment is in the asset, but there's an option underlying it that is not quite as obvious. So there are timing options. There are sizing options, there are flexibility options, and then there are fundamental options. That's probably what I would assign the Harley-Davidson example. But let me tell you another quick story here that I think is worth repeating. When I was in college, I was a little bit of an athlete, and we used to get on buses and planes and go to these faraway places to play. And we would sit there and look at each other because there was nothing to do. I couldn't study, I couldn't write, I couldn't read because I get motion sick. 1982, there was an invention called the Sony Walkman. So all of my teammates and I, we had these headphones on, and we could play a tape, and we could listen to music, and we were jamming and singing, and now the trips were beautiful. Now, I promise you that in 1982, there was a dude, maybe his name was Steve Jobs, that he was working on his Apple computer, right? And he said, you know what, let me start trying to invest in this kind of thing. And boom, 20 years later, 15 years later, there's the iPod. And when that iPod came out, I could put 1,000 songs on that thing. That's a real option. All right, so how are we going to handle these with real options? And so really, there are a couple of different ways, but what the reading focuses on is the following. Is to view the capital budgeting project without the option of itself and say, okay, if we have a positive net present value, let's go ahead and accept it. That makes perfect sense. But then let's go ahead and compute the net present value of another project, and let's suppose that it turns out to be negative. And then we have to say to ourselves, okay, is there something inside of this project that might reveal itself over time? This is what the Apple thing and the iPod did, right? And so I'm sure these engineers, they took apart the Sony Walkman and they looked at all the workings, and they took the stuff that they knew about computer, and they say, boy, if we smash these two things together, I think we can make it work. So they invested in the technology, not quite knowing where it was going to lead. All of a sudden now we have iPhones. My family has iPhones. I don't. But we have iPhones that not only play music, but they call people, right? And you can control your refrigerator on this thing. That's an embedded option. In the academic world, we call that a latent asset. So what we do is we compute the net present value, and then we add the net present value of the option. And we can do it using decision trees or using option pricing models. Oh, you should say, hey, Jim, I'm hoping the next slide is the Black-Scholes-Merton option pricing model. But let me not get ahead of myself. So we'll do that some other reading. But here in real option, the math here is really super simple. So let's work through a super quick example here. New assembly plant, net present value is a minus 600 for whatever reason. So we're evaluating additional investment of $700,000 to enable management to pay over time in the new assembly plant in the event, so there's the embedded option that the new product crosses over to global markets, right? So there's some kind of an expansion option in there. And then the option has an estimated value of $2 million. Oh, I have to say this, right? The estimated present value of $2 million was computed using the Black-Scholes-Merton option pricing model. All right, I had to get that one in there. All right, so we know the NPV is minus 600, so therefore reject, right? However, if we're going to get $2 million out of the option, is that $2 million enough to cover the initial negative net present value and the cost of the option? Because remember, options are not cheap. They're not free. They can be pretty salty. All right, so yeah, we get positive 700,000. So we're going to say therefore accept, because the assembly plant is not going to work out very well, but this option to expand globally turns it into a positive NPV project. All right, how about some pitfalls here? What we've done is we've gone through, kind of this pristine example of being able to accurately estimate cash flows, being able to handle changes in market conditions to compute the weighted average cost of capital, and think about the combination of all of those things that lead us to the correct decision. But what are some pitfalls? If you go back to my 1900 example with the Davidson brothers And Harley, suppose their motorcycle was not super fast. All it did was it enabled them, to chug up the hill and get down the hill and chug up the hill to get to their fishing spot, right? And they said, you know what, we're going to do this as a pet project. Even though we might lose money, we want everybody around us to be able to fish. So pet projects are kind of like a vision in which the executive makes a decision that it's his or her little pet, right? Maybe it's a little puppy dog. Oh, look how cute this puppy dog is. And what does the puppy dog do, right? The puppy dog over in the kitchen, right? He leaves little presents for you all the time. And suppose that the puppy dog never learns to go outside. Even when the puppy dog grows to be, 200 pounds and 4 feet tall, and the puppy dog, who's now a grown dog, still leaves little presents throughout the house. Clearly, that's a negative net present value somewhere in there, right? So we want to make sure that we're aware of being able to accurately predict those future operating cash flows. So be aware of pet projects. Look at the orange one, basing decisions on internal rate of return. Lots of bad things about internal rate of return. The primary one is the simple fact that it assumes that cash flows are reinvested at this much higher internal rate of return, which forces the executives to invest in higher risk projects. Now, of course, the shareholders might want the executives to invest in higher risk projects, but this method forces you to do this. Look at the two ends there at the top. These are a little bit related here. Remember I said that these cash flows were risky, right? So misestimating overhead costs and other costs as well, or failure to consider all of the economic possibilities. Remember, I tell you guys this regularly. I have a really cool colleague who talks about scanning the environment, an environmental scan. This is super important in capital budgeting. Oh boy, using earnings per share, net income, or ROE. Boy, we want to throw that right out the bottom middle. Bad accounting for cash flows. Throw that one right out. So what I've done for you now, and up to this point, is I've shown you how to accurately try to handle all this stuff. All right, so you know what? This is likely, if I were making up an exam question, I would have this as one of those comments where somebody would say something like, hey, let's use net income as our inputs. And you would say, no, we disagree with that. All right, now there are a couple other ways to handle the capital budgeting decision in terms of taking a look at what the project is going to bring us from maybe an accounting standpoint and maybe an economic standpoint. So let's go ahead and look at economic income. And there are some good equations there. You should remember this from level 1. I mean, really, all we're going to do is we're considering changes in values, and then we're considering cash flow. So let's look at a quick example here. So let's go ahead and calculate economic income. So all we're doing is looking at the differences between market values. Now, of course, you could scratch your head and pause and say, wait a minute, Jim, isn't beginning and ending market values based on cash flows? And of course it is, but ending and beginning market values may be able to be observed right on the New York Stock Exchange or the New York Bond Exchange, right? And then there are cash flows there, 30,000. So compute the economic income. And so let's go ahead and just look at the very bottom there. Let's start with the cash flow, 30,000. And then let's take the difference between ending and beginning. So we got the 112 minus the 129. So that gives us economic income of 12,934. You can do that all the way across in those following years. How about accounting income? Accounting income, of course, is way different than economic income. So that's probably a really good exam question. Really all we're going to do. What did I tell you earlier? Make something for pennies, sell it for dollars. This is accounting income in the pure sense of accounting income, revenues minus expenses. So here's a quick example. So we give you a whole bunch of input variables. And let's go ahead and let's just do column 1. So we have the sales and cash expenses and depreciation. So there's an EBIT of $40,000. So we just got that from these numbers here. And then we need to figure out interest expense. So look at the top there. what are we saying there? We're borrowing 50% of that first year's value, the 129, 8% on that. So look at the bottom, 8% times half of 129. So there's the 5174. That gives us 34,826. So take out taxes at 40%. So there's our accounting income, which we probably want to call net income. Here, make sure you are aware of this. Look, accounting income, net income, it clearly has interest expense in it, whereas when we did cash flows, it did not. So here's a good quick slide on the differences between economic and accounting income. I think I mentioned all those things previously. Let's see, economic profit, residual income, and claims valuation, they add some value to our understanding of capital budgeting. And are you ready for this? What is a reasonable estimate of total market capitalization? All right, so let's look at economic profit. All right, so we're going to start with net operating profit after tax. And then all we're going to do is take out the dollars of weighted average cost of capital. So we take the amount that we borrowed times the weighted average cost of capital. Residual income, on the other hand, begins with net income, right? Some measure of accounting income, and then subtracts out what we have to pay the shareholder. So we're going to take out the required return on equity, there's that R sub E, times the book value of equity. And then claims valuation. This goes all the way back to 1958 in Modigliani Miller, where they taught us that the value of the firm is equal to the value of the debt and plus the value of the equity, what we pay the bondholders, what we pay the shareholders. And what do? We invest in positive net present value projects over on the left-hand side of the balance sheet. Whoops. So let's go ahead and skip to the bottom there. So notice market value added. For each of these, all we're doing is going to take the summation of the economic profit. We're going to take the summation of the residual income to get, some kind of measure of market capitalization. And then over on the right-hand side, under claims valuation, we're just going to take the market value of the debt and market value of the equity. And that gives us some estimate of total market capitalization. Here's a super quick example here. EBIT 40,000, tax rate 40%, initial investment, economic profit is closest to. So let's do that net operating profit. So you do all that stuff, you get 24,000. We borrowed 240. There's the weighted average cost of capital of 10. So we got 24 minus 24. Economic profit is 0. And that takes us through all of these. So when you get to this, vignette, I want you to think of Jim and his broccoli, and Arthur Davidson and his little motorized bike, and Jenny and Johnny on the golf course.